Hi CA students, let's revise CA Final AFM Chapter 6 Portfolio Management Practical Question 11. The returns on stock A and market portfolio for a period of 6 years are as follows. So 6 years data is given, return on A and return on market portfolio. You are required to determine characteristics line for stock A and the systematic and unsystematic risk of stock A. So characteristic line is nothing but alpha plus beta into return on market. So what is this and what is the significance of this characteristics line? Characteristics line of a stock shows the relationship between the return of the stock and the return of the market. It is same like the beta, but beta is towards the sensitivity of the return towards the market this thing. And characteristic line brings in one more element, which is the intercept, which is alpha. So what is this? This is nothing but, even if the, let's say if the return is proportional towards market by, let's say some 1.5 beta, that much it is sensitive. Like if market returns goes up by 10%, and if the beta is 1.5, then the stock will go 15%, right? But some stocks will perform even if the market growth is zero. Let's say if the market growth is zero, still the stock's return will give fixed 5% or 10%. So that is intercept, which is nothing but the actual return minus the expected return on portfolio will give us the intercept. Now going further, characteristics line will be helpful in most of the graphical representations of a stock's performance towards the market return. Now in our case, the characteristics line will be alpha plus beta into return on market portfolio. Beta can be found out by using simple regression method, and alpha, as I previously told, the actual return minus the expected return on portfolio. So for this anyway we need beta. So first we'll calculate the beta. For that we have return on A and market portfolio is there. As we previously told, beta will be the sensitivity towards the market return. So both returns are plotted, and then for the regression formula, sigma xy, summation of xy is required. So xy summation is 508, then minus number of expected return of x and expected return of y is required. In this case, expected return of x is the market return, so which is nothing but 5.75. The summation of the weighted average of market return 34.5 divided by 6, 5.75, and the same case goes with return on A, 38 divided by 6, 6.33. Now x square is also required, and then number of expected return square, that also can be calculated, and the beta of return on A is 1.202. Now the next step is to calculate the characteristics line, wherein we require this alpha portion. As we have found out, the expected return of A is 6.33. So 6.33 minus beta into expected return on market 34.5, which will get us 0.058. Hence the characteristics line is 0.5 minus 0.58 plus 1.202 multiplied by the market return. So here, as we can see, the alpha is minus 0.58. So this signifies that even if the market return is 0, the stock is giving a negative return of 0.58. Then added with the beta change 1.202 into market return will give us the stock's characteristics line, which signifies the relationship between the return and the return of the stock and the return of the market. Now the second requirement is the systematic and unsystematic risk of stock A. So systematic return can be found out by this formula, beta square multiplied by market's variance. So in our case it will be 1.202 the whole square multiplied by the deviation we require. So deviation, so the market risk is 40.14, which will give us the systematic risk. And the total risk will be the